our center does. So a brief background. Research Center undertakes research on financial markets and on the Indian economy in general, and it is open to researchers and contributions in those lines. The center is policy oriented, and we try to accommodate as many people who work on policy as well. And our research orientation is also towards policy. Our benefactor is also oriented towards regulation and policy. And as we can see that there have been many fiscal and monetary developments in India, and we encourage researchers all around the globe to help us understand what are the implications of these research policies. In general, we try to facilitate research at IIM Ahmedabad by providing faculty with research support, but we are very, very open to providing support in terms of whoever comes up with ideas towards developing Indian economy or towards Indian economy and Indian financial markets. So this is our center, and we hope that many of you who are attending this session have ideas and pitch ideas towards us, which we can very well sponsor and maybe even undertake as a future project. And this being an introduction of the center, which is hosting this event, and I would warmly introduce Professor Deniz Okat, who is also my dear friend and co-author. And he has been doing research in industrial organization and game theory and other aspects of financial, and most importantly, aspects of banking. He's a professor at Aalto University of Science and Technology, and we invite him to present his paper on which enlighten us towards this this event. Yeah. So Deniz, I welcome you.
Thank you very much. Thank you for having me tonight. Yes, my background is beautiful. It is actually HKUST campus, and I have to say I was inspired by Vasu, by Professor Elapoli. Yesterday I had Zoom call with him, and in the background he had a fascinating building with red bricks. I was thinking probably he got it from Google, wallpaper type of things. It turned out it is the building of Indian Institute of Management. I felt very jealous. I mean, it's like a remarkable, fascinating looking building really. And I wanted to show off our bright campus. Today, we will talk about, I guess I start sharing my screen. Right, you can see my screen, I guess, yeah. So this work is with Bünyamin from Sabancı University in Istanbul and Nan from Durham University. In the next 1 hour, we will talk about one interesting financial instrument, and it's called a convertible bond. Convertible bonds constitute only a small fraction of total corporate bond universe in the world, and in particular in the USA. Total outstanding corporate bonds in the US is around $50 trillion. And only less than 2% of this number, actually $700 billion of it, belongs to convertible bonds. It is relatively small, the outstanding amount, but it is very important because convertible bonds are usually used by small firms, startups, and most of the big firms today, just like Google, Intel, Apple, Microsoft, they were once a startup. They started their business in their garage, and their first financing was through convertible bonds. So it is really important instrument, and we need to understand why convertible bond. This is the textbook, Principles of Corporate Finance by Brearley Myers and Franklin Allen. some of us are using to teach corporate finance to undergraduates. In one chapter, they are explaining other financing contracts other than equity and debt, and they talk about convertible bonds. There's a survey made by Graham and Harvey. They surveyed managers of firms which issued convertible bonds, and they asked, why are you issuing convertible bonds? And the response, the majority of these managers, they responded as saying, well, convertible bond is less expensive than vanilla debt, than straight debt. Obviously, if you believe in efficient markets and if you believe that everything is priced well, this argument really doesn't make much sense. And Bradley Myers and Allen in their textbook also refuse this argument and says, taken at its face value, this argument doesn't make sense. But we suspect that this phrase includes some more complex and rational motives. And in this paper, we will try to provide one of these rational motives, why a firm would issue a convertible bond, how it is helpful generating value. In the literature, there are some answers to there, and three main papers that provide some sort of justification to convertible debt are here. The first one is Green JF paper from 1984. This is a very influential paper. And their argument, or his argument, is the following. Convertible debt is useful because it aims to mitigate one particular agency problem, and it is asset substitution or risk shifting. When the entrepreneur obtains financing from a debt holder, then he has incentive potentially to gamble with the money. If the upside potential of the risky project is very promising, very attractive, then he will basically gamble. This is what we call risk shifting while teaching to MBAs, one of the essential agency problems in a firm. Convertible bond solves this issue. How? Whenever the entrepreneur has an opportunity to undertake a risky project at the expense of debt holders, if the debt is convertible to equity, then bondholders or debt holders will simply convert into equity, and it will reduce the potential payoff of the existing owner. So existing owner knows that whenever he engages in risk-shifting activity, he will trigger a conversion and his payoff will be less. At the end, he will abstain from undertaking a risky project. This is Green's justification for convertible bond. Jeremy Stein in 1992, again at JF paper, he offered another explanation. When there is adverse selection, meaning once the investors cannot identify, cannot distinguish good firms from bad firms, then convertible debt might serve as a signal. How? If you are the owner of a good firm, you can issue a convertible debt because you know that in the next period, once your type is revealed, bondholders will convert into equity because you are the owner of a good firm, and there will not be debt remaining outstanding at that point. But if owner of a bad firm issues a convertible bond, next period, once its type is revealed and it turns out a bad firm, debt holders will keep the debt. They don't want to convert into a low equity value. So because the debt will stay in the firm, if financial distress is very costly, then owners of bad firms will not issue convertible bond in the first place. So in Stein's universe, convertible debt serves as a signal purpose. If you are only a good firm, only then you issue a convertible bond. Myers also offers another rationale, another justification for convertible debt. and it is the solution to debt overhang problem. Sometimes when the firm has huge amount of debt, the owner doesn't have incentive to undertake some positive NPV projects because the profit coming from these projects will be transferred to debt holders. So owner doesn't have really much incentive to undertake good projects when there is huge debt. But if this debt is convertible to equity, debt holders observing that the firm is suffering from debt overhang, they will convert into equity and even positive NPV projects will be then undertaken. Thus, convertible bond, in this case, solves the debt overhang problem. As you see, all these three explanations aim to solve one sort of agency problem, either risk shifting, either adverse selection, or debt overhang problem. In our paper, we will provide a novel justification for convertible bond, and as it will be clear later, actually convertible bond creates value by introducing an agency problem, not by solving it. It is surprisingly, it works in the opposite way. We will see how creating one problem can solve another problem. So what we do in this paper, I was mentioning to Vasu about the story of this paper. I am involved in many projects, but in this project, I'm probably the only one, it started with the right timeline. We first established a theory, a novel theory, and then really naively go to data, test it, and obtain quite robust results. So first, I will talk about this theory part. So the paper has both theory and empirics. First theory, and then we will move to data and see how empirical support we obtain to our theory. In a nutshell, the theory it says that convertible debt provides a commitment to an entrepreneur in reducing the intensity of competition. When there are two firms competing, let's say an R&D race, they are trying to find a vaccine to a disease, they are competing and wasting a lot of resources, then convertible debt, I will show you, help them reduce efforts of both entrepreneurs a little bit, which will improve the welfare. Then we test our predictions and we observe that firms are more likely to issue convertible debt when competition is intense. I will talk about these results in detail.
Maybe I can jump in, Deniz, and ask you this question that what does it mean when you say that the rival does the same? Is it issue the convertible debt or is it not participate in competition?
Very good. Rival does the same. Here it's a very opaque word. You are right. What I mean by same is reducing the intensity of competition.
Fair.
So when two firms are competing, it is actually in the next slide. One way to reduce the competition is asking both firms to reduce their efforts. And it is actually coming in the very next slide. So before building the theory, it is helpful to understand this mechanism. So we have to first go back to Jensen and Makeling. Jensen and Makeling's paper, as you know, it is by far the most cited paper in finance/economics. And what they say, among others, the first time they talk about agency costs in a firm, conflict between the manager and the shareholder. One of the ideas, one of the theories they built at that point is that outside equity or issuance of equity dilutes the shares of the manager. And because the manager owns less fraction of the firm, he has less incentive to put effort. Basically, the the amount of effort the manager invests or puts in the firm depends on his shares. In extreme, if the manager doesn't have any shares in the company, if he's working only at the fixed wage, then he doesn't have any incentive to put any effort in that extreme situation. This is the moral hazard story of Jensen and Mackling. Another channel which Jensen and Mackling doesn't talk about is the effect of outside equity on the rival firm. So we know that outside equity, issuing a new equity, dilutes the entrepreneur's stake and lowers his effort in the firm. Thus, the value of the firm goes down. But on the other hand, because he puts less effort, his rival benefits from this. And this reduced effort, in turn, increases its rival firm's value. This second effect is very important for our purpose. While imagining the stories that I will tell tonight, it is maybe easier to imagine an R&D race. Two firms competing, they are trying to find a solution to some problem. Going back to 1980s, economists are already established that R&D race results in wasteful investments. Too much competition is not very good. Why? Suppose I am a firm and there's a future problem. I expect a problem to come in 5 years from today. And I can invest some money to solve that future problem today, but it will cost a lot. I have to pay, let's say, 10 million US dollars today, then I will have solution. Or I wait 1 year and then solve the problem because the technique will be much better in 1 year. I can just pay only $1 million next year to solve it. So it might be optimum for a standalone firm to wait a little bit for the optimum start of the R&D. But when there is a competition today, preemption motive is so high, I don't want other firm to obtain the cure before me. So it incentivizes me to invest even today. This is socially inefficient. So firms competing in R&D race, they actually benefit jointly if they mutually reduce their efforts. Cooperation between two competing firms would improve their total profits. This is a well-known result from economics literature. The problem is such cooperation is not sustainable because effort is not observable. Even if my rival firm says that, don't worry, I will not put much effort, I will not come to work early, I will not push so much on the tasks, it is not observable. I cannot write a contract upon such promise. He has always incentive to deviate. This is the spoiler. At the end, we will see that we will develop a simple theory model and we will see that convertible debt helps sustain this cooperation between competing firms. This is why it creates value. In order to see it, let's do a little bit of game theory at a very simple setup. Here, suppose, for the sake of this example, there are only two firms. Firm one, it's a row player, and firm two, it's a column player. Each firm has only two strategies to choose from, either issue equity or debt. And suppose, for the ease of solution, this is a sequential game. So firm one first chooses between equity and debt, suppose to finance its lab, finance its firm, and then firm two, observing firm one's decision, chooses its own financing contract. You will ask where these numbers are coming from. I will provide a foundation to these numbers in the 2 slides later, but for this slide, accept that the numbers are just like this. Okay, they are given to you as like this. So you are firm one, you are choosing between equity and debt. In each cell, the first number is the payoff or the firm value of the first player, and the second number is the firm value of the second firm. As you see, if you are a good friend of game theory, this game is called Prisoner's Dilemma. And each player here has a dominant action. So if firm one, for example, chooses equity, then firm two's best response is to choose debt, because debt gives second firm $4. Equity gives only $3. That is better. If the first firm chooses debt, second firm is still better off choosing debt, because 2 is greater than 1. So in this particular game, debt is the unique equilibrium. The first firm chooses debt, and the second firm also chooses debt. This is the unique equilibrium. How unfortunate. Each firm's value is only $2 in this equilibrium. However, there is another nice strategy profile. If both firms issued equity, their firm values will be 3 each. But equity, unfortunately, is not an equilibrium outcome of this game. One way to obtain this nice, efficient equilibrium is expanding the strategy space of the first firm. If I allow first firm not only choose between equity and debt, but also you can issue a convertible debt. In particular, suppose that firm one issues debt with face value 1, which can be converted into 1/3 of the equity. So,
maybe I'll jump in, Deniz, since you're. So, a quick question on this: like, if one has to achieve this equity, one can also rely on correlated equilibrium, which is like trying to find an external guy who is flipping the coin or sort of trying to figure out funds to move these two firms, competing firms, towards equity. Like, I think that's what firms do generally. They seek out external agent generally who is a consultant whom they pay for, in spite of the fact that they know that if they collaborated, they would have been better off finding equity.
Correct. So if in the coordination games, when there are two equilibria, usually, for example, one typical example is bank runs. Like if there are two depositors, you are one of the depositors. If you believe other depositor will run to bank to withdraw, you don't want to stay home. You want to run as well. But if the other depositor, if you believe that he will be at home, you want to stay at home. There are two equilibria, and now we don't know which equilibrium will be played. And if we have a correlation device, some people say sunspots, looking at the sun from our house. If there's a sunspot, we decide to run. If there's no sunspot, we don't run. Would give a correlated equilibrium. In this particular game, with the given numbers, it will not work. And the reason is there is a dominating action here. No matter what firm one plays, firm two will always benefit from debt. So firm two can never benefit from equity. Okay. So if this 4, for example, 2.5, and if this 4 is also 2.5, then your suggested equilibrium would work. In those cases, then they might benefit from referencing some external device to correlate their actions. In this particular one, unfortunately, the unique equilibrium will be debt. Now, suppose that firm one issues debt, but not a simple debt, but convertible into equity. So if the debt holder wants, he has an option either to stick to original debt, which has face value of $1, or he can convert into 1/3 of equity. Now what happens? Once firm 1 issues convertible debt, firm 2 is now thinking, if I issue equity, firm 2 owner thinks, then the first firm's value will be either 3 or 4 if I issue equity. In both cases, these debt holders, owners of convertible debt, will find it beneficial to convert their debt into equity because they are getting 1/3 of firm value. So if firm 2 issues equity, conversion will be automatically triggered, and thus firm 1 will be as if it has issued equity. So in that case, firm 2 will receive 3. But if firm 2 issues debt after observing that firm 1 has issued convertible debt, then the firm 1's value is either 1 or 2. In neither of these cases, conversion will be triggered. If you are the owner of the debt, would you keep the debt with face value 1? Or would you like to have the 1/3 of the firm value, which will give you only 1/3? Well, that is better. It means if firm 2 issues debt, conversion will not happen. So we will be in debt equilibrium, and firm 2 will receive 2. Obviously, 3 is greater than 2. So it is the best response of firm 2 as a response to convertible debt action of firm 1 is issuing equity, which will, yes.
So we have a question from Ashish Chadha. He said, is 33%, let me rephrase this question. Is there a maximum limit for efficient outcome out of this? So he's asking whether 33% is the maximum limit for efficient outcome. But the real question, I suppose, is there a limit to maximum outcome from?
Good, yeah. With 1/3 is working here properly because 1/3 of 3, it makes the debt holder indifferent between conversion and not conversion. If this conversion ratio is higher than 1/3, debt holders wouldn't be indifferent. They will convert their debt automatically.
Yes, I think, Deniz, you're right. As in, this is an empirical aspect. But I think the question probably revolves around that. Is there a overall upper way to understand the efficiency that one would achieve in terms of what is such a...
Right. So here, if we assume that capital market is competitive, I mean, how much surplus we will leave to debt holders or investors is a bargaining question. But to simplify the exposition, if we just assume that the capital market is very competitive, then 1/3 of equity is the unique outcome. Because if firm 1 issues, if the conversion rate is more than 1/3, it cannot be less than 1/3, otherwise there will not be conversion, and this wouldn't work. But if the conversion rate is more than 1/3, then debt holders, investors would make some profit, and firm 1 would leave some money to them. It will just transfer some money from the owner of the firm to investors. So here with the 1/3, I am assuming perfectly competitive capital market. So investors compete to provide financing. This example conveys the main idea, how convertible debt incentivizes the rival to issue equity. Now, I would like to make this point a little bit more theoretical. I will not go into details, but I would like to sketch a simple model, a little bit foundations of those numbers, how we came to that point. I can see some questions. 1/3 means yes, 33%.
I have curated those questions, so
okay,
fine.
I see.
Yeah.
Okay, good. So let me set up an environment. I don't know how much you are familiar, but in theory work, we usually spend quite a bit about the setup and the assumptions before going to the analysis. Suppose a universe where there is one inventor, an entrepreneur. As I mentioned, you can imagine him like there's an inventor who would like to find a cure to certain disease. He needs to open a lab. Let's focus on this story. This inventor needs to raise $1 to set up a lab, to put his lab equipments. And afterwards, there will be a rival inventor who will raise the same amount and establish a competing lab. After opening labs, inventors simultaneously decide whether to exert effort or not. Now, when I say effort, what I meant is first, private effort. It means it is not observable. It doesn't rely on company resources. Here, effort I am using as Tirol would use in his book. You can imagine it's like waking up early. I come to work every day 6 a.m., leave the work at 9 p.m. And not only that, but while I am at work, I'm really focusing on the task fully. This is putting effort. Or I can choose going to work at 9 a.m., leave the work at 5 p.m. And even if I am at work, I am chit-chatting with friends, replying WhatsApp messages, and so on. So for the simplicity, let's call it this binary choice. Entrepreneur either decides to put full effort or no effort at all. In the paper, we made this effort continuous, but the insight remains the same. Let's keep it simple. The value of an inventor's lab has 3 components. $R fixed return. So once you establish the lab, you will definitely get this $R. And assume R is large enough that this is a positive NPV project. R is maybe 1.5. It is fixed return. You are guaranteed to obtain this. On top of this, if the inventor puts effort, he will get another $R. Let's say $0.2. If he really pushes hard, the probability that he will find the cure increases. And this, in expected terms, we can convert into small r dollars. And the last component, if my rival exerts effort as well, if he works hard, he imposes negative externality on me. His probability of winning the race increases, and I capture this negative externality by putting minus $1 in my firm's payoff.
Deniz, let me ask you here itself, as in, since you progress on the, is there a reason why this is not parameterized, this aspect about computational effect? Is it not a fraction? And you thought of -1 as a solution?
Oh, okay. So -1 is the degrees of freedom I can play. Just for simplicity, I can just make it like some cost, whatever, C gamma, nothing will change, just to reduce the parameters to introduce. It is, that's my just,
So it essentially disappears if one looks at the problem.
Yes, it has no particular, the result doesn't depend on whether it's -1 or -10.
Yeah, in optimization. Understood. Yeah.
Now, for example, if both firms, both entrepreneurs exert effort, try to find the cure with full speed, then the value of lab 1 and also lab 2, these are symmetric firms, will be capital R, small r, and -1. If they put effort. If none of them puts effort, then the value of each lab will be only capital R. Because this small r happens only if you put effort, -1 also only if you put effort. Effort is choice. Well, if I stop the analysis here, it is obvious that an inventor will put effort, right? Because if I don't put effort, I don't receive this R. By putting effort, I am receiving R. So I have to decide to put some cost. Suppose effort costs some C, small c. This is again private cost. If I have to wake up at 6 a.m. every day, I bear some cost. By putting all my concentration in the afternoon in the meetings, instead of chit-chatting my friends or playing chess with someone else, I am suffering something. This suffrage is personal. It is not about firms' resources are wasted. It is just my personal cost, and I capture it with small c. This c doesn't go into the financial statements of the firm, but it goes to the utility function of the inventor. This is the setup that we will consider, but I need a couple of basic assumptions. The first assumption I make is this C is lower than R, small r, which makes sense. If effort costs, if the benefit of effort is too little, then no one would put any effort anyway, and we go home, we close the talk at this point. To make things interesting, we are assuming that putting effort privately optimal. Each investor suffers C dollars, but obtains this small r, which is greater. So our first assumption is that C is lower than R. The second assumption is the second inequality. R is lower than C plus 1. What this tells, this is a strong assumption, but it plays the key role in the analysis. This is the most important assumption. The other one is innocent assumption. What it says is the total cost of effort, social cost, is lower than its, greater than its benefit. When I put effort, what is happening? My firm value increases by R. How about the cost? I personally suffer C, and I impose negative externality on my rival firm, 1 unit. So the total cost is C plus 1. C on me, personal cost, 1 on my firm, other rival firms' profits. Now, if there is a social planner, or if there is a common shareholder of these two firms, this shareholder will tell these two inventors not to put effort, right? Because if they put effort, the total cost in the consolidated balance sheet is greater than the benefit it brings. So this is the central assumption. It implies that from the welfare perspective, if there's a social planner designer who dictates the choices to these inventors, he would ask inventors not to put any effort. This is by assumption. The last assumption is fine. R is greater than 1 because we want this lab openings, a positive MPV project.
Then he doesn't like, is there like some examples of industry where this can be implemented? And I think from a social planner point of view, asking somebody not to invent is like...
So it's a very good question. Apparently in late 1970s, some great deal of work has been invested in this particular question that you are asking, and I will rephrase. And in 1980s as well, even John Tyrrell's PhD thesis is about the question that you are asking. And it is basically, so there is welfare theorem where it says that if you let competition happen, social planner solution will be achieved, right? This is the fundamental, like #1 theorem in the entire economic theory, which provides the foundation for free market economy. Paul Samuelson, Kenneth Arrow, 1950s stuff. But in 1970s, people discovered that in the R&D context, I will give other context as well, when firms compete investing in R&D, there is more investment in R&D than socially optimum. My previous example, for example, suppose there is a potential problem which will come 10 years in the future, some space-related problem, and the solution is needed. 10 years later, we need a solution to be ready. Now, I can invest some money to find the solution today, but it is very costly. I have to set aside $10 million to solve it today. But if I wait a couple of years, technology will progress. It will be much less costly for me to find the solution. I have to pay only, let's say, $1 million if I delay finding the cure. This is optimum if I am one firm. But if there are multiple firms, each firm is having fear of preemption. So everyone would like to invent the cure before the other. This race brings these cures much earlier. The optimum will be wait 3 years and invest in the R&D, for example. But because of this competition aspect, we have to invest today.
Right.
This is waste of resources. The similar point has been made in many other races. For example, there was a race to North Pole. Couple of expeditors, they invest a lot of money and even risk their lives. Some people died to be the first to achieve the North Pole. Some people speculate, who actually received Nobel Prize later, that Nobel Prize winning, perhaps in economics, has the similar thing. Everyone is racing to be the winner, to be the champion in economics, try to promote. And maybe because of this competition, everyone is putting too much effort than what is needed socially. So this is a well-known phenomenon that when people compete on trying to find a cure or develop a new product, they invest more than they should be doing. So this captures to that aspect. And empirically, a closer industry to test this will be high-tech or firms who are investing in R&D, which I will talk about it. Let me skip a little bit ahead. This is the game tree. If I put all these parameters, this is the game tree I would obtain. This is the normal form game tree. For example, if both firms issue equity, we know that no one will, their shares will be diluted, so they will not put any effort. If none of the inventors put effort, each one of them only receives capital R. Let me walk you through this number, for example. Here, both firms issue debt. Because debt contract doesn't dilute the shares of the inventor, it puts his full effort because small r is greater than small c. So the payoff is of each inventor is capital R, small r because he put effort, -1 because his rival put effort as well, and -c because he put effort, and this is the cost of effort. If you stare at this game long enough, you will notice that here capital R is smaller than R plus R minus C, and R minus 1 is smaller than R plus R minus 1 minus C by assumptions, it means there is a dominant action. Both firms here issue debt, just like our previous simple numerical example. Prisoner's dilemma, both firms issue debt. But efficient solution requires cooperation. R here is greater than R plus small r minus 1 minus C because of our assumption. Because of this assumption, R is lower than C plus 1. If you substitute here, you will see that this amount is lower than capital R. So efficient solution requires both firms to issue equity and thus not to put so much effort in competition. But how can they do it? Is there a way to induce cooperation? Good news, yes. And it is the convertible debt. The same story goes through. I will not go through the lines right now with the sake of time. I can see that I have 15 minutes left, I think. So, but the same logic that we have gone through in the numerical example, convertible debt gives commitment power to the first firm to issue equity. This is, in a nutshell, the takeaway of the theory. Convertible debt allows an entrepreneur to make the following speech to its competitor. He says, hey, if you agree to dilute your share, then you will put less effort. My firm value will be positively affected because you are not putting effort, and conversion will be triggered. My equity value will be high. Debt holders would like to have some part of this equity. And once my equity is, once my shares are diluted, I will also abstain from putting effort, and this will be a win-win situation. We will both reduce our efforts optimally. If, on the other hand, you don't follow my suggestion, and if you don't dilute your share, if you just issue debt instead, then my firm value will be negatively affected because I know that you issue debt, so you will put effort, which I don't like. Because my equity value is low, now there will not be any conversion. My debt will stay as debt. And so we will be stuck in this bad equilibrium. We are both issuing debt, we are putting a lot of effort and wasting our resources. This is, we will both lose. Convertible debt gives the entrepreneur to make this speech. This is basically the insight of the theory that we went through. Well, in the theory we went through, rival was certain to be there. But in most of the cases, once you start developing something, you are alone. You start a new product, for example, but it is likely that 1 week later, 3 months later, 6 months later, a rival will try to enter into this industry. So it is not difficult to see that when the rival comes stochastically, meaning only with some probability, then it is easy to show that there's a threshold equilibrium, meaning when the possibility that the rival emerges is low, when there will not be any rival, it is better I issue debt. But if I know that rival is likely to enter, it is better for me to issue a convertible debt for the purpose we discussed. So the theory that we develop in the paper basically gives these insights. Now we would like to test these results. We collect data. Well, we didn't collect. Capital IQ collected this data for us. 7,000 private firms in our sample from the US, spanning 19 years of time, from 2000 to 2018, annual financial statements of these firms we have. Almost 20% of firms in our sample issued convertible debt in their lives. Average convertible debt to total debt ratio is 10%. So we will be looking at these two outcomes. Our left side of the regressions, our dependent variables will be convertible debt dummy, whether a firm issues convertible debt or not, and also convertible debt to total debt ratio. So we will be always regressing these two variables on independent variables. Our firm size is relatively small. Median firm size is 120 million US dollar. So these are small, unlisted firms, which is important. Listed firms, their shares are already diluted. This is the first pass, first regression we do. We regress convertible debt dummy. It is either 0 or 1, whether a firm issues convertible debt or not. HHI is the Herfindahl index, which is a general index to measure competition, widely used. It is a number between 0 and 1. 1 means there is no competition and monopoly. 0 means fully competitive market. What it says is as competition decreases, as HHI increases, meaning competition goes down, firms are less likely to issue convertible debt. And convertible debt to total debt ratio also goes down. Meaning, as competition goes down, firms do not find it beneficial to issue convertible debt, which is exactly what we postulated, what we predicted in the theory. We look at the cross-sectional of these firms which issue convertible debt. Our theory would predict that high-tech firms are more likely to have this effect, more likely to have this R&D type of race. And this is indeed the case. We did all these tests, and honestly, I got surprised that it is, I think, very rare, Vasu should know better than I am, very rare that everything you predict works. This is one of those things that I got super happy. There's only one thing that doesn't work, and I will show you what it is. But as you see, effect is working for high-tech firms, meaning if you are working in the high-tech industry, as competition increases, you are more likely to issue convertible debt. This effect is not there. Competition doesn't have any impact on convertible debt issuance in other industries. Likewise, R&D firms, firms which have intense R&D investments, the effect is there. Other non-R&D firms, there is no significance, 0. And again, for young firms, we only see this effect, as it should be. Old firms are likely to have their shares diluted already, other things being equal. So you want this effect to be observed only, stereotypically, like young R&D intense firms. And this is what we observe in the data. We also do these tests. We want a shock to competition. So far, what we have did here is the pure correlation, obviously. There's no causation, or these regressions are potentially suffering from endogeneity. We need a shock to competition and find its effect on convertible bond issuance. In order to address that, we do two different things. First is industry shocks. This is a very, this is used in many other papers as well. We looked at, for the 18 years of data, we look at the total industry sales. Some years, industry sales dropped more than 5%. Those years, we predicted that competition should go down. when the industry is shrinking, we would expect less firms to enter. And indeed, in those years, when the competition goes down, firms stop using convertible debt, stop issuing new convertible debt. And quite opposite true for the other way around. When the industry is booming, growing, when it is likely that there will be more entry into industry, more and more firms are entering, in those times, firms start using convertible debt more often. This worked, this is here barely. What didn't work is other specification. When we tried 10% drop and 10% increase, for example, 10% drops worked perfectly, but 10% increase, when the boom is really a big boom, we couldn't find any evidence. Results were insignificant, which I'm not reporting, but this is how we observed. And finally, to address endogeneity more properly, we use the following shock. At the beginning of 2013, Department of Justice closed 4 regional antitrust offices in Dallas, Cleveland, Philadelphia, and Atlanta. It is important because they have altogether only 8 regional offices. They basically cloned down half of them. And apparently this created quite controversy. Department of Justice, some officials had to provide a testament in the Senate for this, because a significant number of prosecutors have noted that the elimination of these offices will diminish the likelihood of uncovering local or regional conspiracies in competition. Basically, when you close down the office in Atlanta, you are somehow reducing the competition. You are letting firms to cooperate more often, legally or illegally.
Just to have one question from the audience, Deniz, it's like when the so Rajdeep here asks, when the industry is growing versus slowing or growing, requirement for financing will also grow. How does it explain the results in the table? As in, what he's trying to hint at, I suppose, is that the sources and the variety of possible ways in which some financing can be done, whether it be equity related, most likely equity related, might be affected when the industry is growing. So does he's empirically, it's an empirical question, I would say.
This is true, definitely. But I believe this, for example, our variables are ratio. This is, for example, convertible debt to debt ratio. It is true that when the industry grows, the debt capacity increases, but we are looking at the fraction within this debt. Which fraction of this debt is convertible debt? So I am assuming, yes, the base is increasing, denominator, but numerator is also increasing. And in this case, yeah, the effect you observe is still there, I assume. So we are looking at the closing of these regional offices in a defensive setting. So what happens here is from 2008 to 2017 only, some part of our data only, offices were closed down in January 2013, meaning this dashed vertical first line is the exact time of closing of offices. But we have annual data, and we see immediately the impact in the next year. Here, the dashed line is the probability of issuing a convertible debt or average convertible debt ratio of the companies which are located outside of the states of these closed down offices. And the solid line is the average convertible debt dummy for the firms which are located within the same state where these closures happened. And as you see, after the closure, because competition goes down, now firms do not rely on convertible debt anymore. The other variable, convertible debt to total debt ratio, gives the similar picture. So we have perfectly somehow working instrument here or event. And our definitive estimates basically just confirms this insight. The distance, this is the miles from the nearest antitrust office. Using zip codes we were able to find for each firm, and after the closure dummy. After the closure, when the distance increased for a firm, if a firm previously was close to an office in Dallas, afterwards it is close to an office in, I don't know, San Francisco, which is like a longer distance. This increasing distance reduces competition, and convertible debt issuance also goes down with that one.
I have one general on the empirics setting as such. As in like, well, when it comes to convertible debt, the choice is whether issuing debt, or the competing choices are both equity and debt. So some of the results can be checked with reference to equity, especially when they're reducing competition. It might be much cheaper to issue equity.
Yeah, this is a good suggestion. I need to convey.
As in some of the results, as in somebody mentioned that in the booming market, and you presented the idea that yes, we are taking the relative issuances rather than like overall issuances. So that addresses the issue, but at the same time, the equity might be a cheaper option when competition is lower. So
Right.
that's an overall idea. But other than that, if a firm contingent on the fact that it is issuing, has been. So one might also need to, as an additional robustness, not just the overall issuances, one might also want to look at contingent on previous experience with issuing.
Right.
Because one initiates into this
Yeah,
like
you are right.
convertible. So
Yeah.
a company which has already done that might look at this whole strategic thinking as an option. But then, because right now it is slightly, it might not be an option for a company which has always thought about debt and equity purely.
You are right. It is actually in my mind, like if you issued already a convertible debt and suppose it was converted 2 years later, the firm
Right.
is still in our sample.
Right.
If it is converted, its shares are already diluted. The next issuance of convertible debt will be different, will not be as effective as the first one.
Yes.
So yeah, we need to check the first.
And these are just robustness. I think the results are good enough to support the theory. And
yeah, I hope
as
so.
you say,
Yeah.
Deniz, I think our audience is pretty much, we are out of time on this presentation. I think if you can give us like a couple of slides of your conclusions, that will be great.
Yes, very good. So what we did is we are providing a new theory on convertible debt usage, why a firm can benefit from convertible debt. And it is the following: competing firms which cannot commit to lower the intensity of competition, they jointly benefit from the usage of convertible debt because it gives them an option to lower the efforts and the intensity of competition. Convertible debt increases value, very surprisingly, because unlike previous literature, the agency problem it introduces, because when you issue equity, there's a moral hazard, you don't put much effort. It is helpful in reducing this wasteful investments coming from intense competition. Thank you very much. This was the first time we presented this. I enjoyed it. It was very useful for me to put together all the ideas. And especially I like the comment on the first experience thing. Thank you.
I think we have had a great session from Professor Okat on this. What I should say is how competition affects the way one finances. It's been studied, but especially with respect to like convertible debts, it's a very, and the more important aspect is he has been able to, the story makes a lot more sense. The theory comes before the empirics. So Ashish, one of the participants, says thanks for a wonderful session. And we will also like to thank you for a great session and for getting into very thorough detail into explaining to our audience in a very simplistic manner what you have done and
thank you.
And it was great having you. And hopefully someday we will be able to host you in person. And I thank you for I thank you from on behalf of the Misra Center. I thank you, Riddhi, for organizing this conference. Thank you all the participants who asked questions and participated enthusiastically. All right, so have a great night tonight, and see you all in the next session. Thank you.
Thank you. Bye bye.